Welcome to the deep dive. You know how sometimes a company just feels more valuable than, well, its buildings or cash might suggest?
Yeah, definitely. There's more to it than just the tangible stuff.
Exactly. What about those hidden strengths, the things you can't even put your hands on? Today, we're unlocking a treasure chest of insights from our sources.
hmm
We want to completely reshape how you think about business value, zeroing in on intangible assets with indefinite lives.
It's a fascinating area.
Our mission, to make you well informed about this invisible backbone of modern companies. Hopefully, plenty of aha moments along the way. Let's unpack this.
And that's exactly where the balance sheet reveals some of its most intriguing secrets, really.
Intriguing secrets, I like that.
We'll explore what these unique non-physical assets actually are, how they come into being,
Okay.
and critically, what happens when their perceived value maybe starts to fade, even if they're still, invisible.
Right. We're going to give you a shortcut, basically, to understanding concepts like goodwill
That infamous term.
and how companies track massive investments in everything from, say, developing cutting-edge software to inventing the next big thing.
Yeah, the big bets.
By the end of this deep dive, you'll see company financials in, well, a whole new light.
Hopefully.
So let's kick things off with the big question. What exactly are intangible assets, especially those with indefinite lives?
Right.
I mean, most of us were wired to think of assets as something concrete, like a factory or maybe a fleet of trucks.
That's a very natural starting point, but yeah, time to expand that view a bit.
Okay.
Intangible assets are basically long-lived legal rights and competitive advantages. Things a business either builds internally or, maybe more commonly, acquires from another entity.
So non-physical.
Exactly. Non-physical assets. They can be very specific, like a patent protecting a new drug,
Mm-hmm.
a copyright for a best-selling novel, or maybe a franchise agreement for a popular coffee chain.
Right. Those make sense. You can sort of picture the paperwork.
Yes, but then there are those that are not specifically identifiable. And this is where it gets particularly interesting,
Okay.
because the most common example of that is something called goodwill.
Ah, goodwill. Okay, that's a term you've probably heard thrown around, but yeah, it can be a bit nebulous, a bit fuzzy.
It really can.
So, an intangible asset has an indefinite life if there are no foreseeable limits, contractual, legal, economic, whatever, on how long it'll be useful.
Precisely. No built-in expiration date, so to speak.
And you mentioned goodwill as the prime example.
Mhm.
How do these things actually get reflected on a company's financial statements? What does it look like on paper?
So for these indefinite-lived intangible assets, their value on the balance sheet, what we call their carrying amount, it's basically the original cost to acquire them, less any impairment.
Okay, cost less impairment.
And here's a crucial concept for you.
Mm,
When we say a cost is capitalized, it means it's recorded as an asset on the balance sheet.
right, not just expensed right away.
Exactly. It gets recognized as an expense over time rather than hitting current income immediately. But what's unique about indefinite-lived intangibles is that because they don't have a finite useful life, they're not amortized.
Not amortized. Okay, explain that.
Amortization is essentially like depreciation for a physical asset, spreading its cost over its useful life.
Okay.
Since these assets are theoretically forever, well, there's no set period to amortize them over.
That's a really significant distinction. So, if they aren't amortized, how does goodwill specifically come into play? It sounds quite different from, say, a patent you can literally point to.
It truly is very different. Goodwill represents those valuable yet non-identifiable resources and elements of a company
Non-identifiable. Okay.
that cannot be reported separately on the balance sheet. This could be things like exceptional management, a really rock-solid brand reputation, maybe superior customer loyalty.
The secret sauce.
Exactly. Or even the collective technical brilliance of a workforce that you just can't value individually. Essentially, goodwill captures what we call excess earnings power.
Excess earnings power. Tell me more.
It's a company's ability to generate profits above and beyond what its individual identifiable assets would typically produce on their own.
Okay.
For you as an investor, this might signal a premium valuation based on these non-physical strengths,
Yeah.
but also highlights a portion of a company's value that's, frankly, difficult to liquidate or verify independently.
Excess earnings power. I like that. It captures that secret sauce idea. But something caught my attention in the sources. You can't just create goodwill internally and add it to your balance sheet, right? Why not?
That's a critical point.
Mm.
Absolutely right. Goodwill generated internally, or goodwill that isn't part of a formal acquisition, one company by another, it simply cannot be
They're
capitalized.
not.
It's not recognized as an asset on the balance sheet in those cases.
Yeah.
The only time goodwill is recognized as an asset is when it arises from a business combination.
A merger or acquisition.
Right, meaning one company acquires another in what's known as an arm's-length transaction. This ensures the value is based on a verifiable transaction, not just someone's internal guess.
Okay, that makes sense. It needs a measurable transaction. So if company A buys company B, how do they actually calculate that goodwill amount? What are the methods?
Well, our sources describe two primary methods. The first is the acquisition method. This is the one commonly used when preparing consolidated financial statements.
Okay.
Under this method, goodwill is essentially the excess of the total fair value of the company being acquired
The total price paid, basically.
over the fair value of all its identifiable net assets. And importantly, this includes any identifiable intangible assets like patents or established brands they might have.
Right. So it's like if you pay $100 million for a company, and after you value all its physical stuff, its patents, its trademarks, maybe that only adds up to $70 million.
Mm-hmm.
Then that extra $30 million you paid, that's the goodwill.
That's exactly it. That clarity really helps, yeah.
Okay, what's the other approach then?
The second is the equity method. Now, this applies when an investor company has significant influence over another company, an investee, but doesn't necessarily have full control or ownership.
Okay, like a large stake, but not majority.
Precisely. In this situation, goodwill is calculated as the excess of the stock purchase price over the fair value of the share of the net assets that were acquired.
Got it. And once you've got this goodwill on the books from an acquisition, you can't just keep adding to it by, say, hiring more brilliant managers or running a fantastic marketing campaign, can you?
No, you can't.
The material we reviewed mentions that costs associated with maintaining, developing, or restoring goodwill are actually expensed, not capitalized. That feels a bit counterintuitive, but such a valuable concept.
It does feel a bit odd on the surface, I agree, but it strongly reinforces that principle we talked about.
Yeah.
Internally generated goodwill isn't capitalized.
Ah, okay.
These ongoing costs, marketing, training, etc., are considered just part of running the business, necessary to sustain its existing value, rather than adding to a separately acquired asset.
So you can't just boost your balance sheet by saying your brand got stronger this year because you spent a lot on ads.
Exactly. The spending gets expensed, not added to the goodwill asset.
Okay. So if these indefinite-lived intangible assets, especially goodwill, aren't amortized, how do companies manage their reported value over time? What happens if they truly lose their sparkle, as you put it earlier? Do they just sit there forever?
No, definitely not. That's precisely where impairment testing becomes critical.
Impairment testing, right.
Intangible assets with indefinite useful lives, other than goodwill, must undergo an impairment test at least once a year,
Annually.
like a mandatory annual health check for these visible assets.
How does that even work for something you can't really touch or easily measure? It sounds, well, abstract.
It does, but there's a process. Companies actually have an initial option to perform what's called a qualitative assessment.
Qualitative, okay, like a preliminary check.
Exactly. It's like a first pass to determine if it's more likely than not, meaning a probability greater than 50% that the asset might be impaired.
So, just looking for warning signs.
Pretty much. They carefully review all sorts of relevant events and circumstances that could signal trouble.
What kind of circumstances are we talking about? What flags would they look for?
Well, our sources list quite a few. Maybe rising raw material or labor costs that squeeze profitability, or negative financial indicators like consistent cash outflows from that part of the business. Legal or regulatory changes could definitely play a role.
Sure.
Even entity-specific events like a big shift in management, losing key personnel, or heavens, even contemplating bankruptcy.
Wow, okay.
And broader things too, industry or macroeconomic conditions like market downturns or suddenly finding it hard to get capital, all those factor in.
So they look at all that, and if they conclude, nah, probably okay, right.
If after this qualitative review, a company concludes the asset is not likely to be impaired, then a more detailed quantitative test isn't required for that year.
Save some work then.
It can. However, a company always has the unconditional option to just skip this qualitative step and go straight to the quantitative test if they prefer. Maybe they just know things aren't looking great.
Okay, so what does that quantitative test involve for these other indefinite assets? Not goodwill yet, just the others.
Right. For indefinite-lived intangible assets other than goodwill, it's generally considered impractical to estimate all the future cash flows you might get from using them. It's just too fuzzy.
Makes sense.
So the test simplifies things. The company just compares the intangible asset's current fair value to its current carrying amount on the books.
Fair value versus book value.
Exactly. If the fair value is less than that carrying amount, an impairment loss is recognized for the difference. Simple as that.
And once that loss is figured out, how does it actually show up? Where do you see it?
An impairment loss is reported as part of income from continuing operations appearing before income taxes.
Okay, so it hits the income statement.
Yes. And then naturally, the carrying amount of the asset on the balance sheet is reduced by the amount of that loss. It gets written down.
And can you ever write it back up if things improve?
Generally, no. Restoring a previously recognized impairment loss is prohibited unless the asset is specifically being held for disposal.
Yeah.
But for assets you're still using, the write-down is usually permanent.
Okay, so that covers other indefinite-lived intangibles. But what about goodwill impairment specifically? Is it the same process or are there different wrinkles?
It's quite similar in principle, but with a crucial distinction in how it's measured and applied.
Okay.
Just like other indefinite-lived intangibles, goodwill is tested for impairment at least annually. Standard procedure.
Right.
However, goodwill impairment is assessed at the reporting unit level.
Reporting unit level. What exactly constitutes a reporting unit in this context?
Good question. A reporting unit is typically an operating segment of a business, or sometimes even one level below that operating segment, like a specific division within a larger segment. This distinction is vital because it means the goodwill associated with one part of a large company, say one division, might be impaired.
Well, others are fine.
Exactly. While other parts of that same company might be doing just great, with their allocated goodwill completely unimpaired.
So a massive conglomerate with many different divisions. Maybe only one division's goodwill takes a hit, which then impacts the overall financial picture, but not necessarily everywhere.
Precisely. That makes a lot of sense.
And does goodwill also have that initial qualitative assessment option, like the other intangibles? Can they do that first pass?
Yes, absolutely.
Yeah.
The qualitative assessment for goodwill impairment works exactly the same way.
Okay.
A company can choose to first determine if it's more likely than not that goodwill is impaired by evaluating all those relevant events and circumstances we discussed earlier.
The same list of potential red flags.
The very same. And just as before, they have the unconditional option to bypass this qualitative step and go directly to the quantitative test if they want.
Okay, let's dive into that quantitative test for goodwill then. How does that work in practice? How do they calculate the impairment, if any?
Right. Goodwill impairment occurs when the carrying amount of the entire reporting unit, and this includes its allocated goodwill, exceeds its fair value.
So the whole unit's book value is higher than its market value.
Essentially, yes. But the actual impairment charge recognized has a cap.
A cap?
Yes, it cannot exceed the value of the goodwill specifically allocated to that reporting unit. You can't impair goodwill below zero, and you can't impair other assets through the goodwill impairment test.
Okay, let's use that example we have. It sounds helpful. Omega Inc. has two reporting units, Alpha and Beta.
Okay.
Alpha's book value, including its goodwill, is $500,000. And $50,000 of that is specifically the goodwill part.
Got it. $500K total, $50K goodwill.
Beta's book value is $675,000, and its goodwill portion is $75,000.
$675K total, $75K goodwill for Beta.
Okay. At year-end, they figure out Alpha's fair value is only $480,000, but Beta's fair value is $700,000. So based on those numbers, is there any impairment?
Okay, let's break it down. For Alpha, its reporting unit fair value, $480,000, is less than its book value of $500,000.
Right. It's underwater by $20,000.
Exactly. That $20,000 difference indicates impairment. Now we check the cap. Is that $20,000 difference less than or equal to Alpha's reported goodwill of $50,000?
Yes, $20,000 is less than $50,000.
So the full $20,000 difference would be recognized as an impairment loss for Alpha.
Okay, Alpha takes a $20K hit. What about Beta?
For Beta, its fair value of $700,000 is actually greater than its book value of $675,000.
So no problem there.
No problem at all. Beta's goodwill is not impaired. So the journal entry for Alpha would be a debit to impairment loss for $20,000 and a credit to goodwill for $20,000, reducing its carrying amount. Nothing happens for Beta.
That example really makes it concrete. It shows how that loss is limited by the goodwill itself. Very clear. Now, this is fascinating. Our sources point out that private companies have some alternative accounting methods for goodwill that differ from public companies.
They do, yes, and
Yeah.
it's quite a significant difference under U.S. GAAP. Private companies can elect an accounting alternative to actually amortize goodwill.
Wait, amortize. But we just said indefinite-lived assets aren't amortized.
We're correct for public companies.
Okay.
But private companies can choose to amortize goodwill on a straight-line basis over 10 years,
10 years, okay.
or even a shorter period, if they can really justify that a shorter useful life is more appropriate.
So that's a stark contrast to public companies who don't amortize goodwill at all.
Huge contrast.
Yeah.
And the practical effect of this for private companies is, but because goodwill is being systematically reduced over time through this amortization.
Impairment is less likely.
Exactly. Impairment is less likely to occur because the book value is already decreasing steadily.
That makes perfect sense. You're chipping away at the value, so there's less risk of a sudden large drop needing impairment. Are there other options for private companies regarding goodwill?
Yes. Couple more. They can also choose an accounting policy, which they have to disclose in their financial statement footnotes, of course, to test goodwill for impairment only when a triggering event occurs.
Triggering event, like those red flags we talked about earlier.
Precisely. Instead of testing annually, they only test if something bad happens that suggests impairment might be needed.
So not necessarily every year.
Potentially not. This alternative policy, once chosen, must be applied consistently to all their goodwill. And finally, a private company can also elect to perform that initial qualitative evaluation of goodwill impairment at the end of each reporting period, whether it's an interim period or just the annual one. More flexibility there.
That's a really comprehensive overview of how those invisible assets like goodwill are managed. It sounds like accounting sometimes plays hide and seek with value, but as you said, for good reason, right? To reflect reality.
Trying to, yes, it's a
Right.
balancing act.
Speaking of investing in that unseen value, what about the costs of actually creating new innovations? That brings us to the complex world of research and development, or R&D costs.
Yes, R&D.
What exactly qualifies as R&D for accounting purposes? What fits in that bucket?
Good question. Research, as defined in our sources, refers to the planned efforts a company undertakes to discover new information. The goal is to either create a completely new product, service, process, or technique,
Okay, discovery.
or significantly improve one that's already in use.
Mm-hmm.
That's the R. Then D, development, takes the findings from that research and formulates a plan or design to actually create the desired item or make those substantial improvements.
So maybe inventing a new type of super efficient solar panel, that's research.
Could be.
And then figuring out the factory process to mass produce it cheaply would be the development part.
That's a good way to think about it, yes.
Got it. Now, what's the general rule for accounting for these costs? Because, for a pharmaceutical company or a tech giant, R&D can represent absolutely colossal investments, billions sometimes.
It truly can.
Mhm.
And the general rule is surprisingly strict, maybe even counterintuitive to some.
Okay.
For most research and development costs, the only acceptable method of accounting is to directly expense them.
Expense them immediately.
Immediately. They hit the income statement in the period they're incurred. Gone.
Why? If they're building future value.
The rationale behind this is the very high degree of uncertainty about whether these R&D efforts will actually result in future economic benefits or a marketable product.
The risk factor.
Exactly. It's inherently risky. So for that cutting-edge biotech startup, pouring millions into R&D
They look less profitable on paper.
consistently show lower profits, yes. Even if they might be building something game-changing for the future, that's a crucial insight for you as an investor. You can't just look at the bottom line number.
You have to understand why it's low. Is it losses or investment?
Precisely. You have to understand where the company is investing for tomorrow.
So a company can pour millions, even billions into R&D, and it all just gets expensed in the year it's spent. That still feels a bit strange if they're confident they're onto something big. Are there any exceptions to that expensing rule?
Yes. Thankfully, there are a few important exceptions. 3 key ones.
Okay, let's hear them.
First, if tangible assets, think materials, equipment, maybe even entire facilities, are acquired specifically for R&D projects, but they also have alternative future uses beyond that one project.
Like a general purpose lab machine.
Exactly. Then those specific assets should be capitalized. They're recorded as assets on the balance sheet and then depreciated over their useful lives. just like any other tangible asset.
Okay, so the machine itself is an asset.
Right. However, and this is the subtle but important distinction, the depreciation expense on that equipment for the period it's used in R&D.
Ah, that still gets expensed.
That depreciation is still charged to R&D expense in the period it occurs.
Okay, so you capitalize the asset itself, but the cost of using it for R&D still gets expensed year by year through depreciation. That's a critical nuance for reading those financials.
It really is.
What are the other exceptions?
Second, if a company undertakes research and development work on behalf of others under a contractual arrangement.
Like contract research.
Exactly. Those costs are treated as a cost of sales by the company doing the work, not expensed as their own R&D. It's part of the service they're selling.
Makes sense. And the third?
Third, remember our discussion about acquisitions. If a company acquires another company, any in-process R&D, ongoing R&D projects at the target company, those specific acquired R&D costs are capitalized as an intangible asset.
Ah, so acquired R&D gets capitalized, but internally generated R&D gets expensed, consistent with the goodwill logic.
Very consistent, yes.
Are there any common activities that people might mistakenly think are R&D but aren't treated that way for accounting, things that get excluded?
Absolutely. Our sources clearly list several common ones. For instance, routine periodic design changes to existing products.
Like minor model year updates.
Yeah, or troubleshooting issues that pop up during the normal production stage. Those are generally considered manufacturing costs, not R&D. Similarly, things like marketing research, general quality control testing during commercial production, or maybe just reformulating an existing chemical compound without fundamentally changing it.
Those fall elsewhere.
Typically, they fall into categories like selling and administrative expenses or maybe production costs, but they're not classified as R&D expense. The bar for significant improvement or new discovery is quite high.
Okay, we have another example here, Julisle Co. that seems to pull all the R&D expense rules together. Let's run through it.
Sure.
Julisle Co. incurred a few different costs. They used $400,000 in materials specifically for R&D projects.
Okay, materials used.
They acquired a piece of equipment for $2 million that will have alternative future uses after the R&D is done.
Right, the tangible asset exception might apply there.
Then they had $500,000 in depreciation on that specific equipment during the year related to its R&D use.
Depreciation on the capitalized asset.
Plus, they had $1 million in personnel costs for R&D staff, $100,000 in consulting fees paid to R&D experts, and $200,000 in allocated indirect costs, like utilities for the R&D labs, all directly related to R&D projects.
Okay, that makes a cuss.
So how much did Julisle Co. actually expense as R&D for the year? What's the total R&D hit on the income statement?
Right, let's tally it up based on the rules. The materials used, $400,000, that's R&D expense.
Check.
The depreciation on the equipment, $500,000, even though the equipment itself was capitalized, the depreciation related to R&D use is an R&D expense.
Check.
The personnel costs, $1,000,000 R&D expense. Consulting fees, $100,000 R&D expense. Indirect costs, $200,000 R&D expense. So if you add those up, 400 plus 500 plus 7 plus 1,000 plus 100 plus 200, that comes to $2,200,000. That total should be expensed as R&D in the current year.
And the $2 million cost of the equipment itself.
That $2 million is not expensed as R&D. Because it has alternative future uses, it's capitalized as a tangible asset on the balance sheet. It will be depreciated over its useful life, and only that annual depreciation amount hits the R&D expense line each year it's used for R&D.
That really draws a clear line. What gets capitalized versus what gets immediately expensed, especially for things used in R&D. Very helpful.
Glad it clarifies.
Now let's pivot to another crucial area, especially for modern companies. Computer software development costs.
Ah, software, yes.
Our sources say there are actually different rules depending on whether the software is developed for sale or if it's for a company's own internal use, right?
That's absolutely correct. The accounting treatment is quite distinct between the two scenarios.
Okay, let's start with the first one. Computer software developed to be sold, leased, or licensed to customers. How does that work?
Right. Here, companies typically expense costs incurred until a critical point called technological feasibility has been established for the product.
Technological feasibility. Okay, what does that mean?
It means all the early stage work, like planning, initial design, coding the first bits, preliminary testing, all that upfront riskier stuff gets expensed as R&D.
So again, you're expensing the uncertain part because you don't know if it'll actually work or sell yet.
Exactly. High degree of uncertainty means expense it.
When exactly is technological feasibility considered established? What's the benchmark or milestone?
It's typically established upon the completion of either a very detailed program design that confirms the product's technical viability,
Okay, like a full blueprint.
or alternatively, when a working model has actually been created and tested, once
Yeah.
you've passed that critical hurdle.
The it actually works point.
Kind of, yes.
Yeah.
Once technological feasibility is established, costs incurred after that point, but before the product is officially released for sale, are then capitalized.
Capitalized. Okay, what kind of costs fall into that bucket?
This would include further coding to build out features, more extensive testing, quality assurance, and the production of the initial product masters needed for duplication.
So early stage uncertainty, expense. Once you've proven it can work and you're building towards release, capitalize.
Got it. You got it.
How do they then amortize these capitalized software costs once the product is finally out there generating revenue? How is that handled?
Right. Amortization starts once the product is ready for release.
Mm.
The annual amortization for this type of software is calculated on a product-by-product basis, and it's the greater of two calculated amounts.
The greater of two. Why?
One calculation is based on the ratio of current revenue to total anticipated revenue, the percentage of revenue method. The other is just straight-line amortization over the software's estimated useful economic life.
So you calculate it both ways.
And you take the higher amortization expense figure each year.
Why the higher one?
It's designed to ensure the software's value on the books declines relatively quickly, either as it starts generating significant sales early on, or just as its estimated useful life ticks by, whichever method results in a faster write-down.
Reflecting the fast-changing nature of tech and software value.
Exactly. It helps reflect its potentially rapidly changing market value.
Interesting. And what about the actual physical production costs, like duplicating disks or packaging, if companies still do that, or maybe server costs for SaaS products?
Costs incurred to actually produce these saleable product duplication, packaging documentation, maybe some direct infrastructure costs for delivery, those are treated as standard product costs and are charged to inventory, just like making any other product.
Okay, inventory costs.
And the capitalized software costs themselves are then reported on the balance sheet at the lower of their unamortized original cost or their current market value, where market generally refers to their net realizable value, what you could actually sell them for.
Lower of cost or market standard practice for assets. Okay, so that covers software developed for external sale pretty well. What if a company develops software strictly for its own internal operations? Or maybe acquires it just for internal use? Are the rules significantly different?
Yes, quite different again for computer software developed internally or obtained only for internal use.
Like a custom CRM or logistics system?
Exactly. Companies' expense costs incurred during the very early preliminary project state. Think initial brainstorming, evaluating alternatives, determining needs.
Early stage, expensive. Sounds familiar.
Yes. They also expense any ongoing costs related to training employees on how to use the software and any routine maintenance costs.
So training and upkeep are expensed. What then gets capitalized in this internal software scenario?
Costs incurred after that preliminary project state, and importantly, for any substantial upgrades and enhancements that add new functionality to the internal use software, those costs are capitalized.
Okay, what kind of costs specifically?
This can include direct costs of materials and services used, the payroll costs of employees directly involved with developing or upgrading the software, and even certain interest costs incurred specifically for funding the project during development.
Interest costs too. Okay. And once this internally developed software asset is capitalized, how is it typically amortized? Is it that complex greater of two calculation again?
No, it's simpler here. Capitalized costs for internal use software are typically amortized on a straight line basis over its estimated useful life. Much more straightforward.
Straight line. Okay. That makes sense for something you're just using internally. One final intriguing point on software from the sources. What happens if software initially developed purely for internal use turns out to be so good, so robust and valuable that the company decides, hey, maybe we can sell or license this to outsiders?
An interesting scenario.
How do they account for that unexpected revenue stream?
Right. If software previously developed only for internal use is later sold or licensed externally, any proceeds received from those sales are first applied to reduce the carrying amount, the book value, of the software asset on the books, all the way down to zero if necessary.
So you basically pay back the capitalized cost first?
Exactly. You recover your capitalized development cost first. Only after the carrying amount has been reduced to zero is any remaining proceed recognized as actual revenue on the income statement.
That ensures the company first recovers its investment before recognizing profit from an asset that wasn't originally intended for sale. Clever?
It is. It prevents recognizing revenue prematurely on something built for internal purposes.
Wow, what a deep dive, seriously, into the often unseen world of business assets. We've unpacked everything from what truly makes an intangible asset indefinite
hmm
to the very precise moment a company draws that line in the sand for its R&D costs. So, wrapping up, what does all this mean for you, the listener?
Well, if we try to connect this to the bigger picture, I think understanding these concepts is just vital today. It really highlights how much of a modern company's true worth often isn't held in its physical property,
Factories and machines.
but in these less tangible, sometimes hidden elements like brand, technology, know-how. It also really illuminates the careful, often complex accounting considerations behind what might seem like straightforward business decisions. It really emphasizes the importance of critical thinking when you look at a company's reported financial health. Don't just take the numbers at face value.
Absolutely. Knowing when a cost is expensed versus capitalized, I mean, that directly impacts reported profit, right?
Hugely.
Or understanding how an impairment works for something you can't even put your hands on, like goodwill.
Yeah,
It truly sheds a whole new light on financial statements. It's not just numbers, it's about understanding strategic investments and risks.
couldn't agree more. It's about the story behind the numbers.
And it's truly eye-opening when you start digging in.
And this raises a really important forward-looking question for all of us, I think.
Mm.
Given the increasing importance of intellectual property, brand reputation, technological innovation in today's global economy, how might our understanding, and maybe even the accounting rules themselves, for these indefinite-lived intangible assets continue to evolve in the future?
Hmm, that's a big one. Will the rules keep pace with how value is created now?
Exactly. What new challenges or opportunities might arise as these assets become even more central to business success?
A perfect thought to mull over as you navigate the business world. Thank you so much for joining us on this exploration of the invisible.
My pleasure.
We really hope you feel much more informed and perhaps, yeah, a little more curious about the hidden forces shaping the companies all around us.